Welcome to Smart Franchising with FranSmart. I'm Dan Rowe, and I've masterminded the ascent of local favorites to global dominators. This isn't your usual get-to-know-you chat. We're diving deep. We're revealing the raw truths about franchise wealth building. With over 30 years in the trenches, I'm spilling it all. If you have an appetite for unfiltered tales and the hidden blueprints of franchise prosperity, buckle up. We're diving in. All right, welcome back to Smart Franchising with FranSmart. Today, we're going to get an inside look at how PE companies or PE guys look at building large franchise companies with Neel Bhargava with NB Group, a large 110-unit, multi-unit, multi-brand franchisee of European Wax, Crunch Fitness, and I'm sure many more soon. This is an interesting finance-focused look at building a franchise company, and I'm excited to dig in. There's a lot to learn here. And two things I want people to take away is one, how they could do something like this. And two, how they could shape their franchise company. So somebody like Neel wants to be your franchisee. So Neel, how about a little bit about your background?
Yeah, sure. Thanks, Dan. Looking forward to talking more about this today. So I run a firm currently called NB Group. We invest across multi-unit businesses, both franchise and non-franchise, have had some good success in the franchise space with the brands you mentioned. I've done other things in the past, larger scale private equity style investing, advising large companies on growth strategy, operational efficiency in other areas, and also a little bit of entrepreneurial operating company experience as well. But what we do now is we look for exciting brands and concepts in the retail services space to invest behind, and can definitely tell you more about how we do that.
Yeah. What about franchising? So actually a little bit about your background before you even got into this. What's your education and what do you sort of, how did you sort of grow up through the ranks? And then I want to get into why franchising.
Yeah. So went to undergrad at University of Michigan. That's actually where me and my current business partner met. To study business undergrad, knew that, that's what I was going to do when I graduated. And that started off, kind of general consulting role, learning general business skills, and move into investing. Went to business school at Harvard, and really used that as a point to shift to a more entrepreneurial, sort of career. Likely focus on investing, but just in a more entrepreneurial way. While I was at a larger private equity firm prior to Harvard, spent time in the sort of retail space, more traditional retail, but we had some franchise businesses as well, and got exposure to this business model. And then when I started my own firm, NB Group, in 2017, we looked at investing in the space, just given my experience, and ultimately we found something we really liked in Crunch as a result of some thematic work we did around health and wellness and fitness and gyms. Why franchising? I mean, we think about it as we're looking for multi-unit brands. They can be franchised or not. We're not afraid of franchising, though. I think, there was a bit of a hesitancy by private equity in the past, call it 10 plus years ago, to invest in franchising. I think the real concern is, you don't control your destiny as much when you're part of a franchise brand. The franchisor makes a lot of the decisions. They can curtail your growth. They influence, what the product is. They influence your marketing strategy. You have less control. And private equity owners, we're majority investors. We like to have control. So, outside of some large quick service restaurant brands, there hadn't been as much investment in the franchising space, but you've seen that change quite a bit, I think, over the last decade. And we've always been comfortable, with the right brand and the right situation to take on some of those risks.
What do you think about your background, both in finance and in management consulting? Because those are really, really good fundamentals to learn. But what do you think about that really helped you with the business that you have now?
Yeah, I think so. Management consulting, I think, gives you a really broad-based business training, like in the real world. You learn, you see a lot of different businesses, most of which are, large, doing a lot of things well, but you're also helping them solve problems. So you learn about problems businesses face, how to solve them, how to sort of put frameworks and analysis around all of that. And then also, sort of selling solutions to the client. So there's a lot you learn there. I think that just prepares you for many different avenues you can go down in business. And then on the finance, private equity side, that is what I do now. I do it in a much more entrepreneurial way and with different size of companies and types of companies than I did when I was at a larger firm. But certainly, how to analyze businesses, how to, drive growth of businesses, how to work with management teams, all things you learn, when you're in a private equity finance, role.
Yeah, so many franchisors and franchisees. I mean, franchisees a lot of times are buying someone else's systems, but both franchisors and franchisees, so many of them are missing finance and strategy and analytical and being able to actually read financial statements and compare one franchise to another. And if your goal is an investor is to invest in something that's so profitable that you want to keep growing, you want to keep compounding your return, eventually have an exit and, look back and that was a really, really good exercise. You got to kind of know what you're doing. So, I mean, I didn't go to college, so I'm jealous of your background. I learned the hard way. It took me 10 times as long as it takes you to do anything. But no, that's it. That's a good skill set to have. So run me through Crunch. How big was Crunch when you found it, when you first became a franchisee?
So we invested in our Crunch platform in 2018. At the time, the franchisee that we invested and partnered with had 10 locations, I believe, 10 or 12, depending on when the deal was actually closed. The franchisor overall, the system, it was an emerging brand at that point. It had, I believe, 250 locations across the country, so relatively small. That's the time we invested.
I got to Five Guys when it was 4 locations. I considered that an emerging brand. You think 250 is an emerging brand?
Well, I think its closest competitors is Planet Fitness. I think Crunch is a much more interesting product. But at that time, I think Planet Fitness had over 1,000 locations, and now it's well north of even that. So relative to others in the space, it was more emerging.
Okay, and then how many Crunches do you have now?
So the platform now has, I believe, 65 to 70 in that range.
You keep referring to it as a Crunch platform. What does that mean?
Yeah, maybe that's a little bit of private equity jargon. We describe a platform as it's kind of like one of our base investments. So, we have 3 platforms right now, or portfolio companies. The other term you might hear is an add-on. You start with a platform business, and then you make add-on acquisitions to build it, which is actually the strategy we've pursued in European Wax Center.
Okay. So again, how many Crunches were there when you invested in that franchise company? So you didn't you didn't buy a territory and start from one. You invested in someone that had how many units?
10 locations at the time, 10 units. And now it's up to north of 65.
Wow. So you've grown it 6 times. And then just for scale, without talking out of school, I've never been to a Crunch. How big are they? What's the CapEx? What's sort of the sales?
Yeah, I think average box is 25,000-ish square feet.
Oh, wow.
There's some variability, and the unit volumes, it's changed over time, but these clubs can have several thousand members. So, we're high unit volume. They're very profitable. It's one of the things we really liked about the model was those, profitability and revenue numbers. And then the relative to the build out cost, like your payback is pretty quick. That build out cost has also changed quite a bit over time as across most multi-unit businesses, construction costs have gone up quite a bit, but you're talking, a few $1 million, around that.
Yeah. I've never seen a chain in 30 years where the stores get cheaper to build over time.
Yeah, I'm sure that never happened.
They're always more, but But that's it. So you found a concept. It was an existing 10-unit company. So you had the ability to look at how they ran things, how they ran their numbers, the metrics, and you invested in something, a wheel that was already turning to make it a bigger wheel.
Exactly. And, the management team was, who'd started it and started, it built the first one and then built the next 9 and the 10 and, now the next 50, was really, really, great, strong team. And, they're the ones who've grown it. We haven't, we can't take credit for that.
Yeah. And so let's stay on that for a second, because, you're an investor. So many people think owning a franchise is passive, which clearly it is. It is not. For anyone that isn't sure, it's not a passive thing. You have to be active. In your case, you're not running the business, but you're investing in the people running the business, right? So, I mean, those guys are working their ass off every day, even though they've got a big 60-unit company. It still needs a lot of time and attention, like every minute, right?
Oh, for sure. And, there's, maybe there are some concepts that are more operationally intensive than others, but all of them, to your point, it's not a passive business. Someone needs to be managing it. As you scale, some things get easier, but there's way more complexity. So, I agree with you. It's not passive.
And then that particular platform, the goal is to then keep growing it, and then someday your liquidity options are what?
Well, so we've actually already had multiple liquidity events on that, and we've actually sold the majority of our original stake in the business, so we're not the majority owners of that business anymore. And the initial sale was to another private equity firm, and the subsequent sales will probably take the same route. You just kind of keep selling to other private equity buyers. Eventually, there could be some other exit options, but those are that's really the path that.
Yeah. And it's not a negative thing. That's just how private equity works, is you need a mark and you need your investments to grow, and you got to return capital, right? And so that you can keep doing it. So explain sort of like, to someone that doesn't really understand that, explain how that works.
So to step back, when we look at an investment, we typically plan to hold it for, 3 to 6 years, I'd say. We actually have a lot of flexibility as a firm. We don't have defined hold periods. We can hold things for longer, than that if necessary. But generally, we aim for 3 to 6 years, pretty typical private equity hold period. And, we look to grow the business during that time period. Hopefully the sales grow, the profit grows. And that's the way we aim to make our returns. Growing the business, you sell it, you buy it for X, you sell it for, something hopefully much higher than X. You've also, paid down some of the debt you've used to make the acquisition, which further enhances your equity position in the business. So that's how sort of a typical exit works. In this situation, and there's other situations where this could happen as well. We saw continued upside in the business. When we sold the majority of our position pretty early on, like within 2 years of the initial investment. We saw continued upside, so we decided we're going to sell 75% of what we own, and we're going to retain that other 25%. The business then went through another liquidity event, and we did the same thing, holding or sort of reinvesting the majority of our capital. So it's called rolling your equity into the next deal. And if you believe in continued upside, that's something that, is pretty compelling.
Yeah. Yeah. But it doesn't have to mean a negative event. It was a positive event. That's good. And then, so tell me then about, European wax. I've seen those, like, I know what those are, but how big were they when you got involved? Was it something similar? You invested in an existing thing?
It was a little bit different. It was different in the way it came together. Also, the growth strategies have been different. So it's a good kind of contrast. So with European Wax Center, we put together 4 franchisees to form the original platform. So 4 different groups owning each of them at the time. The largest one of the 4 had 8 units. The smallest had 2 or 3. we put them together. It formed a 13 unit platform, and the largest franchisee of that group of four became the CEO of the combined business. So this was the situation where there wasn't something that had enough scale on its own for us to really want to invest. So we did the work to put those four together and kind of build a company from there. And since then we've made a number of subsequent add-on acquisitions, and that's now at 49 or 50 units.
Wow. So you actually so it was too small for you at first. You rolled up a couple franchisees to get the volume. That doesn't come without some pain too, because now you got to digest integrating all those companies together. But still, it gave you this sort of mini platform to start continued growth, right?
Exactly. I mean, there's definitely, it's not the easiest situation to do. You have to integrate and you have to build a team, right? You have to build a corporate team. Typically, small franchisee groups don't have much, corporate overhead there, and you have to build that. But we felt it was worth it to get into that system and, pursue a thesis around consolidating that system, which, we've been able to do, take it to 49, 50 units.
Yeah. When you first said that franchising it, you weren't into franchising in part because of the limitations, like you might have an idea that you think would make the brand better, but too bad. How are you adjusting to all that now? Like, are you sort of like all the pluses, all the minuses, it's still got more pluses?
I think there are pros and cons to franchising, both as a operator and as an investor. Some of the pros are, there's less upfront thought and work required, right? There's a playbook that has been written for you. You as maybe more so as an investor, a positive is you have data points to go off of, especially if it's a franchise that has, 50 plus units already. There's an FDD, there's an item 19. You can talk to other people and understand what the economics look like, which is very helpful. And it's actually a process we go through every so often is building a database of franchisees by looking through FDDs and other data points, and having an analytical data set we can to identify which franchisee groups do we want to invest in next. So those are some of the positives. The negatives are, back to the playbook, the quality of the playbook varies, and you don't have control to really impact it. For example, you pay into a marketing fund typically as a franchisee, but you don't have any say in how those marketing dollars are spent. They could, the franchisor could spend all that money on a national TV ad that probably doesn't trickle down to you at your local level. You might think, buying AdWords in your local market makes more sense. You don't have control over that. Your growth can be limited by territory rights, not them selling the territory rights you want to someone else. There's issues around cannibalization as the system grows. So these are some of the positive and negatives I think about. I think what I've learned is it is somewhat specific to the brand and the franchisor where you shake out on the pros and cons of that. So really understanding the franchisor strategy, where they are in that evolution. Is it more emerging? Is it more established? How much room is there really to grow? What are their plans? These are all important factors when you think about, investing in a franchise.
Yeah. And then knowing what you know now, like, I mean, you were smart to begin with, but now you have a lot of practical knowledge and, maybe some things that you wish you could have done different. But if you were looking at a franchise or your LPs, like what is a good, reasonable return that you would look for investing like this?
So our target returns for any investment are relatively high, higher than other private equity buyers, I would say. We aim to make at least 3.5 times our money on every investment, and ideally significantly more than that. Meaning, if we invest $10 million, we want to get out at least $35 million or more when we exit.
Yeah. And so somebody that's looking for you to invest in them, I mean, you can do that a couple ways. You can just be very good with the money that you're investing, but also creating enough internal cash to keep building more locations, right? I mean, you got to, I mean, the way you're going to get there, I see so many people that raise money and they have a source and use of funds for the cash, and they don't even hit that, like let alone pull any other levers to compound the returns. But how can somebody think about making 3.5 or 3 times the return in a relatively short period of time?
Well, I think you mentioned something that's key is you need capital to open new locations, and how much capital that takes and how quickly you recoup it is really a really important factor to determining how much you can grow, how quickly, and how accretive that is, or how high the return on that investment is. So one of the most important metrics we look at when we evaluate any multi-unit business is what's the payback period on that new build CapEx. So if you spend $1 million to open a location, how quickly are you going to recoup that through the profits of that location? And really what we see as best in class is 2 years or less. And Crunch hits that. And there's other models that hit that. That's like best. 3 years or less is also good. But if it gets longer than that, it gets difficult to. You think about holding a business for 4 to 5 years. If all your capital takes 3.5 years to pay back, the new locations, you're limiting how much of the benefit you're going to see from that. Now, there are different ways investors think about compensating you for that. You've got a location that hasn't fully ramped. They might give you some credit, for future performance on that. But generally, that payback metric is very critical to determining how much we like a multi-unit concept.
Yeah, I think 2 years is the number we look for, because we're with emerging early stage. So to get someone to stop building, Panera or Orange Theory or something like that to build one of ours, the numbers have to be not a little bit better than those, have to be a lot better than those. What are some of the warning metrics that you see? Like, what are some of the things when you probably see a lot of deals? What's kind of the quick thing that you look at that turns you off of a deal?
Low unit volumes, each location generating 200, 300, even 500,000 of revenue. That's not something we like. The reason being is opening a location requires work and time and attention, and if it only is getting you a few 100,000 of revenue, it's from our standpoint, as given what our objectives are, it's often not worth it, and it just adds complexity, right? Having 50 locations is complex, regardless of how big each location is. So you want those locations to be quite a bit bigger. It also allows you to absorb overhead more when you have higher unit volumes, and as you really scale a business, you do need overhead. So that's one. If the system is declining, overall system size, or it's like plateaued, that's a negative indicator as well. Something else we spend time looking at and understanding is the labor model, which isn't a metric, but it's something you have to understand. And how difficult is the labor to attract? Is it easily replaceable? Is there a risk of labor stealing your customers, which, like in European wax centers, is something we'll think about. So it depends what you're looking at around the labor model, depending on the brand and the industry. But that's another thing that we spend time on.
Anything that you learned along the way? Anything that caught you off guard? You thought that you double checked, but it still was sort of a negative surprise with either of those franchises?
I think that just on the labor model. I mean, the labor model it has been challenging, more challenging than probably expected in in one of those two brands, and it puts pressure on the business model. Yeah, the labor's key. I mean, everybody makes it seem like it's easy, right? Every franchise brochure makes it seem like it's easy, but yeah, to your point. I mean, how easy is it to get and keep labor? And then if they leave and they take
your customers with him. Like that's terrible. And then let's talk about your team. I went on your website and I saw it. Did I see that you have the former CFO of Shake Shack on your team? And
He's not exactly on our team. He's an advisor to us. We've worked
an
with him in
advisor,
the
okay.
past as we were pursuing restaurant investments. We made a run at a few with him. He is, he's got a great background, Shake Shack, Yard House, some other brands. He now runs, I think he's CFO of another brand now. He's a good guy. We've worked with him in the past as we've pursued restaurant investments.
Right. So probably helping you, blow holes in deals and knows what to look for. I mean, the concepts that he's worked with have a lot of moving parts. How about raising capital? Like, how hard is it today to raise capital for you to keep doing what you're doing?
It's gotten harder, I'd say, compared to when we first made the Crunch investment, 2018. It's gotten harder. Both your debt financings, of course, gotten more expensive with rates, and just that's generally makes lenders have a higher bar on what they get comfortable with. And, the equity side has also gotten, more constrained. I think you've seen the financing environment improve over the last year. 2023 and was probably, the low point. It's gotten harder over the last several years. But it's on an upswing for the past year.
Yeah. Interest rates didn't help. Hey, so say one of your MBA buddies sees what you're doing and he's like, I want to do that. What sort of advice would you give him about both scrubbing the investment and then also making sure that he's investing in, and I'm assuming he's going to do the same thing you did. He found a franchisee and he wants to help that guy turn into a platform and grow. Like, what are some of the warning signs that you'd alert him about?
Yeah, well, I've definitely had some friends who have invested in European Wax Center, for example, and other areas. But I didn't get a chance to talk to all of them first. So, yeah, it's a good question. I think I'd probably talk them through some of the things we've just talked about, right? Like paying attention to the labor model, which is not something that data alone can just tell you. People with analytical backgrounds, whether it's through business training or, an MBA or other school, focus on numbers, but numbers aren't going to tell you everything, right? You have to go see the units. You have to really talk to people who work there and have run these businesses before to understand, how they work, and the labor model is one piece of that. But, marketing strategy is another one. And, where your customers are coming from and how that's going to evolve over time. So it's probably a lot of the things we've already talked about. I think the franchisor piece and understanding their goals. For example, if you're investing in a franchise system that has 800 units and the franchisor is saying they want to take it to double that size, what you need to think about is is there really room for that? And as they pursue that, is that going to impact the units that I have? Because there's, just going to be more of this brand's units out there and my customers can now go to more places. So there's things like that you probably learn as you spend more time with franchising, but is not inherently apparent at first.
If you were also just starting out, like, where's a good place to go look for capital for LPs that want to support a model like this?
There's a lot of sources of capital out there. It depends on what you're trying to do, who's asking for the capital, and how much and everything. But I think there's a lot of appetite. There's a lot more familiarity with franchise concepts. Like back to what we were talking about at the beginning of the conversation, it's gotten more familiar to private equity and to private equity lenders, about investing in franchise businesses. So I think that it would depend on the specifics of the size of the investment, who's asking for the money, and what they're trying to do with it. But there is definitely capital that's interested in franchise businesses and multi-unit concepts generally.
Yeah, we see a lot of family offices. We see a lot of high net worth folks that want to get into franchising. They don't want to run the franchises though. So somebody like that would be a perfect LP for someone like you. They could put money into a pool of people that are professionally managing. What do you have to do whenever you invest in one of these entrepreneurs? They're usually running stuff in QuickBooks and usually behind and all that. What sort of rigor and professionalism do you insist that they bring to their game, like with their financials and their admin and just staying ahead of the business part?
Yeah, there's 100 things an entrepreneur needs to manage in their business, and most important for them usually is making money and growing. If they're trying to grow locations, and also delivering a good product, especially when if you're the founder of a business. Your first franchise, you're probably in there. You're talking to customers, you're selling them the memberships. If it's a membership, you're doing everything. Like this really matters to you. So delivering a good product, making money, opening new locations is where you spend time. You probably don't think as much around, building the infrastructure and the systems that could take this to 20, 30, 50, 100 locations. So we're comfortable with that. We know that businesses at the scale we invest originally are not going to have that all that figured out, but that's what we want to help with, and provide resources, capital, whatever it may require to do that. So implementing a more robust accounting system is usually one of them. You mentioned QuickBooks. Usually everyone's on QuickBooks. Usually everyone is using a CPA in their town to close the books. First thing we usually do is hire a finance person at the company, finance and accounting, or potentially we've got some third-party offshore solutions that are really good, that can be your accounting function. So one of those two options we usually implement right away. And then, as the business scales, changing that system from QuickBooks to Sage Intacct or something else that's, more robust is key. Usually there's team building needed. You might need someone to oversee operations, whereas the franchisee was doing all that before. But as you grow and you want to do other things and you've got more locations, you need someone targeting ops. Marketing could be another area, either working with a third party group, and you're limited in what you can do on marketing as a franchisee. But there's usually are some things you can do. So that might be a need, but usually one that comes later. But that finance, accounting, systems rigor is key. And we also put in place dashboards, reporting packages that make it really apparent and useful to everyone, including the entrepreneur and management team, as well as us, to understand what's going on in the business and what do we need to focus on.
Yeah, early on in my career, I never was current with financials. I had a couple shareholders. I never had board meetings. Like, I just sort of wung it. I stayed busy, staying busy, but and then it was after a while, they're like,
but I'm sure that worked for you for a while, right? Like it works for a while.
It did, but it was game changing, like 180-degree game changing the minute I started managing myself and my company like a real company, like with board meetings and accountability and actual budgets and, measuring 3 times, cutting once. And, and I still run into so many people that I get frustrated that they're doing it. And then I catch myself saying, wait, that's what you did. And, so your model is you're looking for really good concepts with great economics so that you can get fast repayment of capital and you can compound and open up more locations. And you want to back a franchisee, an existing person, not a startup, but you want to back an existing franchisee, more or less splashing gas on a fire and giving them the strategy that those guys can just grow. And then you keep recapping the company, taking your piece out and it makes sense.
That's the main strategy. We're an entrepreneurial firm. We're willing to roll up our sleeve and do work and get our hands dirty if needed. So we have thought about other situations where maybe there's not a franchisee group of the size or the team, quality that we want, but we really like this brand or we like this space. Should we actually start it ourselves? And, likely we would finding, someone who has deep operating experience to partner with on that. That's a strategy we haven't executed yet, but we've contemplated. But generally, it's more of the what you described.
Okay, good. Well, no, I appreciate it. This has been helpful. If a brand wanted to attract you as a franchise partner, where can people find out more about you?
You can go to our website, nbgroup.us. You can reach out to me as well if you want to talk. It's Neel, Neel at nbgroup.us. But our website has good information on our strategy, our current investments, what we offer. We've also, we do a lot of thematic work on different areas we want to invest in, and some of that's listed and published on our website. So, start there and feel free to reach out to me if.
Are you also interested in LPs or investors?
We're always, looking to grow our relationships there. So, yeah.
Okay, excellent. Well, I appreciate this, man. You gave me a different perspective than I usually get, yet I find so much more organized capital getting into franchising and Tiger 21 people, YPO people, PE companies. And so I appreciate the insight. So thank you very much. And audience, you know the drill. If you like it, like this and share it, and we will talk to you soon. So thanks again. Hey, thanks for tuning in to Smart Franchising with FranSmart. I'm your host, Dan Rowe. If you enjoyed today's episode, this podcast is only going to get better. Please like, comment, and subscribe to hear more from the most successful franchisors and franchisees, and we'll see you next time.